So good evening, everyone. Welcome. My name's Andrew Thompson, General Manager of CFMG Capital. Welcome to I think it's about our sixth Q&A session. We're trying to do them quarterly. First one in Sydney. Quite a few people couldn't make it. Some apologies due to the weather, but thanks to everyone in the room that did battle the wet roads to get here. We appreciate it. And there's about 100 to 120 people online at home, so welcome to those people. The purpose of these events is sort of like a bit of a value add. We're not here to talk too much about CFMG Capital itself, but more provide some insights on various topics to help our investors with other investments they might be making, their self-managed super fund in the case of tonight, and just general information that will help them with their investment journey. So tonight we've got Clive Todd. Clive's been working as an accountant in the self-managed super fund space for over 20 years, so very much a subject matter expert. And for those at home, so nearly everyone here and most of those at home are current CFMG Capital investors, so not going to go too much into all about us because you all know what we do and most of you invest with us and know all about our products. But we have been around since 2008. We're essentially a land developer that operates funds that give you exposure through lending or otherwise into those land developments and gives you that exposure to residential land subdivisions to generate returns through your self-managed super fund, or for many people that don't invest through their self-managed super fund. So Clive is going to provide some really good insights into trends and key topics. This is actually the second time we've had Clive present at our Q&A, and I think, arguably the most popular presenter we've had so far, so we got him back a second time because it is such a topical issue and he does provide some insights. I know last time he came I was furiously taking notes myself on a few things I picked up. So it's a very good value add for Clive to give us some advice on, not advice, Clive. Give us some information on self-managed super fund strategies and trends, because there is a fair bit of, one of the biggest issues obviously is the amount of legislation change. The government's constantly sort of attacking our nest eggs, so we've got to find ways to mitigate that. So welcome, Clive.
Thank you, Andrew and Scott, for having me. And back in Sydney, Brisbane last year, got to come down to sunny Sydney to do it this year. So it's great that so many of you came out. Got to love Queensland. Today I'm just going to run through a few things. Yes, there is a disclaimer. I am licensed to provide financial advice, but I'm not tonight. So this is all general information, specifically around superannuation. Going to set the scene with a few trends and statistics. What I'm seeing, I look after about 350 self-managed super funds and have been doing so for about 20 years. So I get a bit of an idea as to what's going on in the market and what we're sort of seeing. So I want to talk to you a little bit about that. Yes, as Andrew said, the government sort of had a little bit of a target on the old self-managed super funds for a long time, but they're alive and well. So we'll talk about that. A few strategies. Won't go into too much detail there, but just a couple of things to keep in mind that I think are really beneficial and things that people can be looking at to do. And to say upcoming changes, I think there's only one that I'm sure everyone's aware of. So I'll just cover off on the big ticket superannuation change that's approaching over the next few years. All right, SMSFs, are they dying? No, they're not. Here's just a lot of numbers, but what I want you guys to take away from here is the fact that there's now 610,000 self-managed super funds in Australia, 1.1 million plus members. It's a big area. There's a lot of people taking control of their own superannuation, which I think is a great thing, obviously. But what we've seen, I think, over the last few years, despite all the noise, we're starting to see more and more, like the net establishments is growing. Less people are getting out. Now, people wind up funds for heaps of different reasons. So you die, it's just no longer worth it anymore, or you better options in something else. So people wind up for whatever reasons, but that's shrinking. So I think a lot of the people that have sort of gone and decided it wasn't for them, that got in a while ago, they've wound up already. Now it's people that are committed. There's a big push from the younger generations. Like, I'm quite surprised that I think that the largest growing area is that 35 to 44 year old market. So people, I think, it's great. They've always had super, so they're actually focused on it. So what we're seeing is the younger people getting into superannuation, but also more people just wanting to look after themselves for a number of reasons. Now, how much do they have? Average member balance is about $780,000 in a self-managed super fund, which is slightly less than last year, which I assume is mainly around investment returns, but also the whole point in superannuation is that it's there to provide retirement benefits. So people are drawing down on their super. So as we're seeing with the ageing population, more and more money is actually getting taken out of the superannuation system. So the government gets very concerned about some of these big balances coming around, but the whole point of super is to draw down, and obviously when you pass away, the super has to come out anyway. So yes, it is. It's a good chunk, and obviously I think the average in an APRA fund's about 160,000. So yes, self-managed super funds clearly target more the people with the funds to do it. But are they all big funds? Again, a lot of stuff here, but I think what we're seeing over the last few years is the white noise around people setting up self-managed super funds for the wrong reasons, just to be able to take it out. I've got 50 grand, I'll set up a self-managed super fund. We saw a lot of noise around people doing it for the wrong reasons. That's not really happening. That's dipping down. Like, there's a lot of rules and regulations in place that's stopping people from doing that. But what's growing is the big end. Now, clearly that's where the government has had concerns, and a lot of people are now into that $1 to $2 million in their self-managed super funds. So that's the scale. It's pretty much 500,000 and above. But ASIC's done away with that guidance. I'm not sure if anybody's seen that. Like they said, if you had 500,000 or less, you shouldn't be having a self-managed super fund. They've actually quietly removed that because they've realised that it depends on the circumstances. You can have $100,000 and a plan and investments, and you might be suitable to have a self-managed super fund. You can have $2 million and maybe you shouldn't because you don't really know what you're doing with it. So it shouldn't really be money-based. And they go on about fees. Yes, there is costs. They tend to be static in a self-managed super fund, as those of you with them would know. But there's economies of scale. So once you do get over a certain period, yes, it does make more sense to have a self-managed super fund than maybe a retail or an industry fund. But mainly I think it's more driven by your investments. Anyone doing it to save costs or something is probably not the right motivation to be getting into a self-managed super fund. Now, what are people actually investing in? Mostly shares. The Australian market, investing in Australia is clearly still dominated by two things. Property, we all love property, CFMG especially, and shares. Now, whether that's a good thing or not, I'm a little bit on the fence. Like, the franking credit system in Australia is very advantageous to people investing in shares, especially in a low tax environment like superannuation. But Australia's a small fish in a big pond in the investment world. So something which I still am surprised hasn't ticked up too much is the direct international listed securities. It's very easy nowadays. You can get onto your Comsex or anything and buy international shares. You can go buy your Microsofts or anything, not that I'm saying you should, but there's been a lot of drive in returns from overseas. They've outperformed Australia in the last 12 to 18 months. So we're not seeing people really dipping the toe too much in that. They're still driven by direct equities, the franking credits, and it tends to then leave most people I see with a portfolio that's diversified around banks and miners, with the odd bit of Telstra and Woolies in there. So ETFs, I think, they are growing. It's got a lot easier to just invest in ETFs nowadays. So people are going, well, I don't know whether to pick this share, that share. ETFs are a cheap, low-cost way of accessing a bundle of shares. So we are seeing that rise. Now, everybody's got cash. So this is just slightly different to the last graph, but this is the percentage of funds that own each of these particular assets. Now, I think what's actually interesting here is that direct property is going backwards a bit. So I don't know whether that sort of indicates that people are going, there's better avenues, and this isn't a pitch for CFMG or anything like that, but there's easier, better avenues than going direct into one property. And I've had these discussions with clients before. They go, I've got $1.5 million. I can go buy one property, put all my eggs in that basket, or I could get a diversified portfolio across a number of property funds. So people tend to be leaning towards that, which you see the unlisted trusts, managed funds, they're all actually just tipping up because property, not necessarily if you direct, depends on how much you've got. It's also got a lot more expensive to borrow in super funds. Yes, you can be doing it, but it's pretty expensive to do, and not many providers or actually lenders are actually giving you the money. So that's naturally sort of dying off a bit, I think. The government tried to get rid of it, didn't work from a legislative point of view, but the banks, etc., are self-regulating that. All right. I want to keep this interactive. If anybody's got questions along the way, like that's just a lot of numbers and all the rest of it to set the scene, but if you've got any sort of questions, anything you want to sort of just ask, comments, please just throw them at me as we go, because I want to sort of keep, if you've got things burning, let's just talk about it. So strategies, going back to some of the things I was talking around, the why super's increasing. The work test was abolished 18 months ago, nearly. I think that's been a huge boost, and for multiple reasons here. But if you're aged between 67 and 74 now, you can go back to putting money inside super. You are restricted to just being non-concessional or salary sacrifice contributions outside of your super guarantee, but it's created this opportunity where people were in their 60s, 70s, got a windfall from something, couldn't get it into super, had $300,000 in super at the age of 70 and couldn't put more money in when they inherited that or won it on the Melbourne Cup or something like that. So it's now given those people an opportunity to put money into super and get the same tax advantages that other people were enjoying because they'd been able to put it in.
So what's the yearly limit on how much you can put in?
Yeah, so the question's like, what's the yearly limit? And that's what comes back to the non-concessional contributions. There's catches around this because firstly, at the moment, if you've got more than $1.9 million in super, you can't make a non-concessional contribution. So it's great that you go, right, I've got this money, I'm 70 now and I want to put it in. If you've got more than 1.9 million, you can't put anything in. If you've got less, then you can be doing $110,000 a year of after-tax money. So that's a non-concessional contribution. So there's two types of contributions. One is the concessional contributions, which is you get a tax deduction or somebody's getting a tax deduction for it. And then there's the other one, which is just non-concessional. That's where you just put money into super for this. You want to get it into this tax-effective environment. And I think that's, this golden age of 67 to 74 is where you can be putting money in, but you've also got the ability to take it back out again. So it's really a win-win. If you're 42, you sit there and you go, do I want to put $110,000 into super? Because I can't touch that for another 20 years. But if I'm 67 and I can pull it straight out again the next day, well, then you definitely look at it because you're in that environment. Now, there's a lot of strategies around that. Like, I'm not going to talk too much today about taking money out because we're going to be building our super today, but the non-concessional contributions, and also if you want to be claiming a tax deduction for it, so you put money in, the $27,500 is the concessional limit, but the big catch here is that you need to be working if you want to claim that in your personal tax return. So I've seen a lot of people over the last 18 months that this has sort of happened. We're doing people's tax returns for the 23 year now and they go, yep, I put in my $27,500, I'm going to claim a tax deduction. You go, did you work? No, they didn't work. So if you want to be claiming a personal tax deduction, you need to still be working. Yes?
What about that 1 month? Sorry. If you worked for a month?
Yep. So
does that still apply?
that's exactly what it is to claim those. So the question is, does the 1 month work test apply? Only in the case of if you're claiming a personal tax deduction. So if you're not claiming a tax deduction at all for it, you don't need to be working or you don't need to. And that 1 month, it's a 40 hours that you have to have worked in a 30-day period. And you only got to do that at some point in the year. So you could make a contribution actually in August and work in May, and you've still ticked it off and said, I've done my work for the year. But that's to claim the tax deduction, which is what a lot of people are still after, the tax deduction to do it. But I think the more exciting thing is just getting it money in. Because if you've got money sitting around now, and this is not financial advice, but there's no downside to putting it into super, and people go, super's a bad investment. How we invest it is so, totally different. But you can put the money in there, and if you decide that you want to spend it on a round the world cruise, you can pull it out again if you're over the age of 67.
So I thought the opportunity to do a one-off 300,000, is that right? How does that work? If I put that in, does that mean I can't put anything else in again?
So there's what the question is: can you do a 330 like a one-off? It's not one-off, so to speak. It's 3 years worth, and that's what's called the bring forward rule. So what you get there is the opportunity to go in one hit. I will put in 3 years worth. I'll put this year's in, and I'll effectively bring forward 2 other years. So you put in 330,000. Now that means that you can't then make any further contributions for the next 2 years.
Right.
So, but then in year
You can go again.
4, off you go again. And that's where I think timing becomes great with this strategy, is that you can do that at the age of 74. Now you sit there and you go, well, hang on a sec. If I'm 74 and I'm turning 75 and 76, I can't be contributing when I'm 76, but you can bring forward still. So if you time it well, you go bang, 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 and you can suddenly have the big boost in that later stage of life. So I think the other thing that I'm seeing this being used a lot for is equalisation of balances. So we've all probably heard about the gender gap in superannuation. Now, it's a thing, a lot of people didn't have that, are in their 60s and 70s, didn't have compulsory super. So a lot of them didn't have super throughout their careers. They haven't got necessarily the big balances, but maybe one spouse does have a bigger balance. Here's the opportunity now where they can be pulling out of theirs, and effectively the other spouse with the lower balance can be contributing. Now, why would you do that? The tax savings. So I'm not sure if you're familiar with pension phase, but in a self-managed super or in superannuation, if you've got a pension in place, you pay 0 tax. Now that's gold. Like 15% is the maximum tax rate in super anyway, but when you've got a pension in place, you pay nothing, but it is capped. So currently the limit is you can only have $1.9 million commence a pension with. So if you've got $2.5 million, you've started a pension with 1.9, you've got 600,000 that's still going to be attracting tax on its earnings. And if you've got a spouse with $1 million, you're not getting the best tax benefit. So what can you do now? Pull out 330, give it to them, even if they're not working. So I think what we'll see more over the next few years is better equalisation and better tax benefits for a couple. And I think it's the way it should be. Like, people should be looking at superannuation as a couple. I think it's been fairly unfair in the past that one particular spouse might have had the opportunity to contribute and grow, and hence we get to their retirement and suddenly it's like, well, sorry, you can't put any more money in because that's the rules. Now we're seeing that you can potentially equalise those balances.
So the limit before, quite a few years ago, was 25,000. I think it's gone up a bit. Has it gone up to 100 now?
No, so the questions around what the contribution limits are, there's 2 limits. So there's a concessional contribution limit, which is where you claim a tax deduction for it, or your employer is putting it in and claiming a tax deduction. That was $25,000. Now it's 27.5. And I've got a slide on that in a second. What's the other, the 110,000 is the non-concessional. So that's the after-tax money. That's just money you've got sitting around that you're not claiming a tax deduction on if you put it into super. So 2 different types of contributions there.
What if one spouse is 67 and one is 66? Second spouse can't keep topping up until they turn 67. 67-year-old can't top up on their behalf.
Yep. So the question is, if one spouse is 67 and one's 66, who effectively can contribute? Well, both of them in that situation, because you can be non-concessional. But the 67-year-old would need to satisfy the work test if they wanted to claim a tax deduction for the 27,500. But 66, it's whatever you want. You've got those same limits and there's no work tests. It's just happy days. Now, I think what we'll see is this keep increasing because ageing populations, like people are actually working a lot more. And I'm hearing a bit nowadays about longevity and people are going to be living to 100, 110, 120 and you're going, well, if you've retired at 65, you need a hell of a lot of super. So there may be the fact that these limits will go up even more. 74 might not be the stopping point in the future. I don't want to be working at 74, but you never know. Yeah, 100. Yeah, I'll give up on that. But
Clive, can I just ask a question
yes.
around that equalisation that you just talked about? So if you've got a couple and one's got, I don't know, 1.5 million in super and the other one's got 2.5 million in super and you're trying to pump or less than that, balance it out under the 1.9.
Yep.
And they do that over their lifetime while they're together. If and when then one passes away and it all becomes one again, what happens? How's that treated?
Yeah, that's a good question. So the question's about if you've got a couple, one with 1.5 and one with 2.5 million, say, what happens in the event of one of them passing away and suddenly there's a combined 4 million? Well, it gets a bit trickier here because going back and using the current numbers, you can have $1.9 million in pension phase. So in that situation, I would assume you've got one spouse with $1.9 million in pension phase and $600,000 in accumulation. The other spouse with 1.5 million totally in pension phase. So this may get a bit confusing, so to clarify, really need a whiteboard. But if the person with $2.5 million passes away, that benefit goes to the spouse. Now, they've got $1.9 million in pension. That spouse can just take that on as a pension as is. So they've got that pension in place. The $600,000 that's in accumulation has to be paid out of super. So anything in accumulation that is over and above that 1.9 will have to come out at that point. So death is a trigger point to reduce that.
It's tax-free, isn't it?
Depends on who it goes to. If it's going to a spouse, so the question is it tax-free coming out? The short answer is yes. Going to dependents, which includes spouse, dependent children, any death benefits are tax-free. So that would all come out, that $600,000 would come out. So you've then got the situation where the surviving spouse has a pension of $1.9 million, but also a pension of 1.5. Now you can't have that. So you've got effectively 12 months to then commute your existing pension. So spouse B, surviving spouse, will end up with $1.9 million in pension and $1.5 million in accumulation. Now, they might say, look, I don't want to keep it in there. They might take it out. They could pull the money out and do what they want. But the optimal situation is they've still been able to retain $3.4 million in superannuation out of the four, which isn't a bad one. It's just not all in that pension phase. And when the surviving spouse dies, unless there's dependents again, that'll all have to come out. It'll all just get... And then there may be tax payable if it goes to non-dependents. So that's a trickier one again. Yes?
If the rules were that someone you can only put 1.6 million in pension phase and now it's 1.9, can you take 300,000 out of accumulation and put it in your pension?
Yeah, so the question's leaning towards these numbers. When they first brought this rule in, it was 1.6 million was the magic number that you could put into pension phase. It's now indexed on the 1st of July to 1.9. Can you top that up to the 1.9? Unfortunately, the short answer there is no. So the way that works is that you use a percentage, a proportion of your what's called the transfer balance cap. So if at the time the limit is $1.6 million and I put $1.6 million into pension phase, I've used up 100% of my cap. Now, say for argument's sake, I only used up 90% of it, and then it goes up to 1.9, I've still got 10%. So I get the 10% lift, but if you've used up 100%, it's done. What we've seen a bit over the last few years is, unfortunately, people's 1.6 millions that they started with have dropped down to 1.2. Like volatile markets, etc., and they're going, well, hang on a sec, I've only got $1.2 million in pension phase now. Can't I bring it back up? No. There's no way around that. And really, that's the government's intent, is that does get whittled away, because that is the best tax-free environment you can be in Australia. So that pension phase. So there is obviously going to be some catches to it. Yes.
So you can't bring cash from the accumulation phase into the pension phase once you're at the 1.6 or whatever. You've just got to have a drop in. You can't transfer from the accumulation phase into the pension phase. Is that what you're saying?
So the question's, can you transfer from the accumulation phase into the pension phase if you've already used up the 1.6? And again, the short answer there is no, but there is, and this is where some complicated strategies, which I think are great, and this is why you do need, hopefully, qualified accountants and advisors looking after you guys, because what we do with our clients is, say their minimum pension for a year is $100,000. And they go, well, this year I'm actually taking out $200,000 because I'm buying a car. The $100,000 is pension. The other $100,000 can be a lump sum, which effectively means you can replace that at some point in the future in that pension phase if it's lump sums. So let's get into some of the complexities, but if you are in a situation of where you are in that drawdown phase, you're taking out pension payments and you are taking out more than what your minimum is, there could be some strategies around how they should be treated. And that's not just from now, that's also that death benefit like I was talking about, because when we talk about combining of balances, it means that you could put more in pension phase in the event of one of the spouses passing away. So yeah, different terminology, but you've got two ways of taking money out of super, pension and lump sum, and they're both treated slightly differently. So keep that in mind if you are drawing down, and talk to somebody about your specifics.
I thought if you were drawing a lump sum, it would come out of your accumulation.
If you've got an accumulation, yes, you would normally. Sorry, the question is, would you take the lump sum out of the accumulation? Yes, in the first instance you would. But say you don't have an accumulation at the moment, you could draw it out of the pension account, and then you can be making a contribution and putting that back into, like, at a later stage, and adding that to your pension in the future. Sorry.
What triggers you going into retirement?
So the question is, what triggers you going into retirement? Well, it's not just necessarily getting the gold watch at the retirement party.
Particularly when you work later.
Yeah. The big one here, like the easiest condition of release, is you turn 65. So turning 65 means you've got unrestricted access to your superannuation, irrespective of what you're doing. So you could still be working 50 hours a week, but you've got access to your superannuation at the age of 65. Before that, the magic age is 60, to where you can start to access it. So say you're 60 and you cease an employment arrangement, then you get the same benefits as if you were 65. So they're the two big trigger points. And if you're 60 and above, like say you're 63, you might have 3 jobs and you just have to cease one of them. So that's a big, like, we see that quite a bit, because people have multiple positions and they just stop one, keep doing the other 2, you've got full access.
And there's tax advantages to being retired, is that right?
Well, the big tax advantage there is, firstly, everything that comes out of super once you're age 60 and above is tax-free. So whatever you're pulling out, tax-free.
Even if you're still working?
Yes, so the question is, if you're working still, but you're over 60 and able to access your super, yes, it's all still tax-free. Anything you pull out is tax-free once you hit that magic age of 60. Unless you've got an untaxed element, I won't go into that, but there's potentially some people, like there's a caveat on that, but 99% of people wouldn't have that in their sort of portfolios. So going back to, like, what was the question again? Sorry, Grant.
So what's the trigger?
Oh.
What are the triggers for?
Yeah, the tax benefits. So what's the tax benefits of going into that pension phase? Well, if you put your 1.9 million as it is now in pension phase, because you've ceased a job at 62, put it all in pension phase, you pay no tax on any of the earnings in that $1.9 million earns. Now that's, timing again is crucial here. You've got a property, say, that you bought 20 years ago, and it's doubled in value, you bought it for 800 grand, it's now worth 1.6 mil, you put that in pension phase, you sell it, you pay zero tax. So that's why we see a lot of people potentially realising CGT events after they've retired or after they've met that condition of release. So timing can be crucial, but there's huge tax benefits. Like I say, the golden age is hitting retirement age, getting into pension phase, and then still being able to put it back in again.
And if you have hit the 60, which I have, but I don't have anything like that in there, does it make sense to retire then?
Yeah, so the question's like, how much do you need to make it worthwhile retiring? Well, anything. Like if you've got $200,000 and it's generating $20,000 in income in a year, well, you're still paying $3,000. So if you put that into pension phase, you're paying no tax. So there is still benefits with any sort of amount of money.
So when you click into retirement age, you can still put money into the fund effectively at the same limits that applied before.
So the question is, can you continue to put money in if you have retired? And yes, and that's where this benefit of this work test being removed comes into its own, because not only are you taking the money out, getting all the tax benefits inside the fund. Also, you might need the money, you can be spending it, but if you've got other money from somewhere else in the future, you can be putting it back in. So there's a few other things I'll touch on more around these contributions, because I think this one ties into a bit around this as well. Extra ability to put money into super. The carry forward of the concessional contribution. So the last slide I'm talking about with the removal of the work test is mainly going to be beneficial around the non-concessional. But this is a big, I think, initiative where now if you aren't using up your total concessional contribution limit, which is $27,500 at the moment, it carries forward the amount that you don't use up in the year. So for up to 5 years, your unused amount is carried forward, which means at some point over the next 5 years, you could do it. You could put it in. But catch there, you've got to have less than $500,000 in super. So this is aimed at people wanting to boost their super that haven't had the chance before. I think it's a great one around people going on maternity leave or parental leave. If you've been out of the workforce for a few years, you can top your super back up because you have effectively carried forward the unused amount for periods that you weren't contributing. Another one I've seen utilised over the last couple of years actually has also been kids turning 18. If you're a kid that's been turning 18, you've actually been accumulating unused super caps for the last 5 years. So some fairly wealthy parents have gone, well, I'm going to maybe make a trust distribution to these kids, and they're going to then make a contribution into super that they can't touch for 50 years, but that's now inside super, and there's the tax benefits doing that. So you are accumulating these unused carry forwards, are carrying forward no matter how old you are. So going back to that previous slide, if you're 72, you haven't made a contribution for the last 5 years, you go back to work, you could actually do 5 years worth in one hit.
So if you haven't been working for that 5 years, you've taken leave.
Yep.
How do they work out what your super contribution would have been? Because you haven't had a wage.
So the question is, if you haven't been working, how's your contribution worked out that you haven't been making? It doesn't matter what your contribution would have been, it's the cap. So it's the $27,500 cap. So by not making that cap, any contribution towards that, that is carrying forward. Yes?
The current cap held back, so if you haven't made a contribution for 5 years, is it the cap that's current, like the 27.5 now, is the cap, or is it indexed back?
So the question is, what is the cap? Is it the current cap or is it the previous cap? So no, it's the previous cap for each year. As this slide sort of indicates, so this started in the 2019 financial year. So I've just done a quick example here, and you can see in the 2019 financial year, the cap was only 25,000. That's gone up to 27,500 in the 22 financial year. But you've got that available to you at the start of the year. Now, in this one, I've said in 2019 they've only made $15,000. So what that means is 10,000 is effectively unused, and that carries forward. So in the 2020 financial year, their cap's no longer 25,000; it's 35,000. So that just keeps accumulating every year until you use it or it goes past the 5 years.
If your kid's only been working for 1 year, do you get to claim the 5 years?
Yep, it's if they haven't so that thing, it's not age based, this limit. So
It's not based on having worked at those.
no, you don't need to have worked at all. So this is every single person has a contribution limit cap. Whether you can actually use that is a separate thing. Like if you're 85, you can't. If you're 15, you can't. But well, you possibly could, but nobody's probably going to be making that money. But yeah, in this one, you can see the benefit of coming into the 2024 financial year, and you can be making $125,000 contribution and claiming a tax deduction for it. Now, that's a huge tax deduction to be gaining. And where I'm seeing this be utilised is around capital gains. So people realising a capital gains event and going, well, I haven't made a contribution for a few years. I've got this $300,000 capital gain. Well, my wife and I can both put in our full 5 years worth of contributions in one hit. The other one will be if you've been out of the workforce or you get a promotion or something and suddenly your income's gone up, then you can take advantage of it. So, yeah, it's a good one. Yeah, so it's a strategy where an 18-year-old, like, so parents are sort of going, well, this 18-year-old could be making 5 years of contributions when they're 18. So if they've got the income to offset against it,
From age 14 to 18.
so that's all been carried forward for the previous year. So if they haven't been making any super contributions, and very few kids would, they'd probably all earn not enough for there to be contributions being made on their behalf. Hence, they turn 18, and tricky parents go, well, I can now make trust distributions to them and get some tax advantages. Actually, I can make a lot more, and they can make super contributions. So, again, specific circumstances apply, but it's something to keep in mind. The catch there is not many kids get too excited about a super contribution being made for them. But a lot of parents like the fact that, I know that this money will be there when you're 60, because you can't take it out. Yes.
You can turn that back into property, I guess.
Sorry?
Then the fund could turn that back into property and have it indexed for them.
Yep, the question is like the fund could turn that back into property, and that's getting into a more popular strategy, I think, now is what I'm seeing is the redistribution, the early inheritance of effectively of wealth. So a lot of parents are actually going, and I'll talk about this a bit more when we get into the magic 3 million, but they're going, well, if I've got more money in super than I'm getting the benefit from anymore, maybe I should take some out and actually the kids can contribute that in. Now, then they go, they can be a member of my self-managed super fund, so the money is actually going out, coming back in, and it's still getting invested in the same strategy as what that fund's doing. So it's a little bit of a round robin, but the fund is still existing as this entity. So I'm seeing a lot of family self-managed super funds come about now because you can have up to 6 members. So that's been a real green light for a lot of people with 3 kids, say. A lot of people have 3 kids. They go, well, mum, dad, we can only ever have 2 of the 3 kids in a self-managed super fund before. Now we can have 6. So we can get the 3 kids in, their money can go in there, or I'm not seeing too much where the kids roll their own money in yet, but the parents might start to effectively make contributions on their behalf. And there's a little bit of peace of mind. The parents can go, I know, if I'm not here, you might waste the rest of it, but that's still going to be there. So it's a little bit of like, I guess, dominating from the grave type things. But sorry, you had a questions? Yes.
Is there a time limit on that? Like, if you didn't work for 5 years and you have to do it within the next year, or you have 6 years, or?
It's a lose it or use it. Use it or lose it because it's 5 years. It carries forward to 5 years. So once it ticks over into years, like the 6 year limit that you didn't use 5 years ago is gone. So, but you've got that last 5 years worth that's available. In 10 years' time, obviously, it keeps ticking through, but we're finally getting to the stage where people are losing their contributions if they don't make them now.
It depends when you submit your tax, you've got 8 months to play.
Well, you've still got to have made the contribution though. So I think that the key thing is a superannuation contribution isn't received unless it's physically received inside super. Yeah, so it's got a lot trickier. Like
You want to leave at least a week.
I don't want to sort of spruik the SMSFs again, but one of the big benefits in an SMSF is that you are the trustee and you have control over when the money's going in there. Some of the bigger funds we've seen, if you don't get it in there before a week, it won't clear. It won't be counted as a contribution. So suddenly that's received in July and that counts towards next year, which is less of a problem because of the ability to do this. But if you've got more than 500 grand, it's bad luck. And if you've got other contributions, it's bad luck. So the timing of this one is important. And it all hinges still on that balance of $500,000. So I think, again, if you haven't made your contributions for a few years and you've got $480,000, you might go, this year might be my last chance. If I don't make that contribution this year and next year I've got 501,000, I can't do that carry forward. Conversely though, if the next year after that, markets have gone down, you've got 490, then you can do it again. So it is a year by year basis. You've got to have less than $500,000 in super. Any more questions on that one? Now, the other way to get money in at the moment, which I find like an interesting, the downsizer contributions. Everybody heard of the downsizer? So this is where it was an initiative the government brought in a few years ago to try and combat the housing crisis. So they were going, right, if you sell your principal place of residence, you can put in $300,000 into super, irrespective of how much you've already got there and irrespective of how old you are, maximum-wise. So you could be 95, sell your house and put $300,000 into super, even if you've got 10 million already. So this is outside of a lot of the limits. So this is a free hit for a lot of people. The catch there is you have to have owned that principal place of residence for 10 years. It doesn't have to have been your main residence for that entire 10 years. I think that's a key sort of little bit of a misnomer there. I think a lot of people go, oh, I lived in it for a year and then I've been living in this other house, so it's been an investment property since. If you've got a property that qualifies even partly for the main residence exemption, it counts towards this downsizer. So I am seeing a lot of people sell investment properties that weren't investment properties in the past. It happens quite regularly where, couples come together or they upgrade their house and they might keep one of the old houses. So that was their principal place of residence at some point. If they sell that, they can take advantage of the downsizer. So it's $300,000 per person. And I'll preempt one of the questions I always get. Does it have to be in that person's name? No. It can be in either spouse's name. It can even be in a trust as long as that person is connected to it. If they're in a couple. So any of your tricky sort of asset protection strategies that may be in place, doesn't matter. You still get the ability to do this. Now, it started out, you had to be over the age of 65. Then it's been reduced to 60. Now it's 55. So if you're 55 or over and you sell your main residence, you get a free hit to put $300,000 each into superannuation. Now it is a one-off. So 55 is getting quite young now. You might then own another house for another 10 years and you're 65, you go, well, can I do it again? No, it's one-off. Now, I don't know whether this will be here forever. Like, it hasn't really solved the housing crisis. I haven't seen one person sell their house to do this. I've seen plenty of people sell a house and do it, but it hasn't motivated anybody to sell their house, I don't think.
Get divorced and do it twice.
Well, you still only get one because it's per person. So it is something to keep in mind, though. It's a free hit. And as sad as it is, a lot of the times I've seen people do it is when they go into aged care. So people will move into aged care in their late 80s, sell their house and put a downsizer contribution in. Why not? It's a tax-effective environment to get in there. So now, from an accountant point of view, a lot of people never used to talk to us a lot about, I'm selling my house, because it's tax-free. Well, still let us know, because there could be some strategies around it. And I won't go into all the other strategies that could go with that as well, but you say, well, downsizer isn't exactly well worded, because you could upsize. You could no size. You could just sell your house and not buy anything, go into aged care. You could sell your house for $2 million and buy a $3 million house. You can still put your $300,000 in. So downsize, it's mainly just selling a principal place of residence is the key factor there. Now, my concern here is that 55 is a lower age, and I think the red flag there is I put my $300,000 in, I can't actually pull that out anymore. Like when they first brought this legislation in, it was 65 and over, so you had that sort of free hit going, I put it in, and then I decide I want it out, I can do it. Now you go, oh, I sold my house, I'm going to put it in, and I'm 55, you can't get it back out again. So it may not be, I don't really know why they've reduced it to 55 actually, like I think that's...
Does it affect your CGT event if you put in super, or are you still going to pay the normal super? I know, because it's your principal place.
Yeah, the question was around CGT, but yeah, if it's your principal place of residence, you're not paying tax.
Even if it's principal for 1 year out of 10, you're only getting concessional.
Yeah, so it doesn't impact your CGT calculations or any tax payable at all. So if you've got, like I say, a property that's hasn't always been your principal place of residence, and there will be some tax payable because it's been an investment property, that's a separate calculation. It just means that you can make a contribution into super via this strategy.
No, if the goal is to try and encourage people to sell their big houses and shrink it to 55, that's the intent. Whether it motivates people or not is irrelevant.
Yeah, and that's exactly it. The comments are like, yes, it's hopefully, if you're motivated to sell your $3 million, $4 million house, and really, I think the benefit there too, if I want to be less cynical, is that a lot of people haven't had the ability to make super contributions, like I said, throughout their lives. So you get to 56, 57, and you've got a house that's worth a good chunk of money. The kids have all gone, and you go, well, I do want to actually downsize. Well, now I can actually boost my super. And you might not be able to take it back out, but what you can get is the compound growth in a low tax environment of that $300,000 that you put into super. So there is a win there if you are wanting to boost your super. And I think this is another example, like all these three strategies around the work test, the carry forward contributions, and the downsizer help around that gender gap as well. Because this is giving opportunities to people that wouldn't have otherwise had them if they've been out of the workforce. Yes, sir.
Transfer balance cap still applies to that, right?
No. The question is, does the transfer balance cap apply? No. And that's one of the beautiful parts of this is it doesn't matter how much you've got in super. So you could have $50 million in super, you can still put your 300 grand back in.
In terms of pension phase, though.
Oh, sorry, the pension, yeah, so it's...
It doesn't affect that.
No, so it goes into super, and it goes in as effectively a non-concessional contribution, so there's no tax paid on it going in, forms part of your tax-free. If you've got the ability to put that into pension phase, then you can. If you meet the other requirements, then you can. If you've already got 1.9 million, you've started your pension, you've used that up, this doesn't give you a free hit at that would just sit in an accumulation. But it is only going to attract the 15% tax on the earnings as opposed to what you may be up for in your marginal, personal marginal.
So you can put the 300K and you could still also get the benefit of that carry forward.
Yep.
I think like they're two separate.
Yeah, so the question is, can you get the benefit of the carry forward as well as the downsizer? And this is, again, where timing is crucial. Because say you've got $300,000 in super and you go, I'm selling my house and I'm going to whack my downsizer into my fund. But I wouldn't mind also taking advantage of this carry forward concessional. Well, this carry forward concessional, you have to have less than $500,000. So if you put your 300 in and suddenly at the 30th of June that year, you've got 600, you've lost the ability next year to do the carry forward. So timing is extremely crucial. So anytime we see people, and that's where we map out non-concessional contributions, carry forward concessional contributions, and downsizer. And I had a client just recently do this, and we did some in June and we did some in July, just to get that timing right.
So advice for young people, should they be trying to put the 27.5 in every year if they can?
Look, I think what we're finding, going back to my original statistics around the superannuation, young people have a lot more super than they probably, they used to, because compulsory contributions have been going in their whole lives, and that level's going up, and also their earnings are going up. Like, you've got kids earning, $140,000, $150,000 with 11% going in. There's some big numbers going in there. My gut feel, without giving financial advice, is if you're a 25-year-old, I would probably still be focusing on other things rather than your super at that point. If you get windfalls, you've still got the ability to do your catch-ups along the way, if and when. But, trying to get the money together to get a housing deposit, pay the rent at the moment or buy the odd watermelon, the prices of stuff is outrageous.
As a young person, can you put money back out of your super for deposit on the house?
There's the first home savers,
It's complicated.
yeah, it's very complicated, but yes, you can be doing it. And again, I think I've seen one person actually do that, which I think is a failing of that initiative, because if it's too complicated and people don't understand it, they don't do it. But there was that sort of initiative. Look, I'll move on. They're great strategies, and I'm happy to chat. And look, my details are everywhere. So I could say, please, if you've got specific questions that you want to ask me, I'm happy to answer anything. It is about helping people understand what's going on. Super's a very confusing area. I always laugh, back in 2007, those of you that are older enough to remember, I was told I was out of a job because Simple Super was coming in. And it was like, everything's going to be nice and easy now. You won't have anything to do. Now, since 2007, I've watched it get more and more complicated to now. I honestly, unless you've got people helping you out, I don't know how you keep track. And that's why at Mazars, we have a specialist super area. It's not even the general accountants, because they can't keep up with it either. I will touch on now the big change coming from the 1st of July 2025, which the government is forging ahead with, which now has a name, the Division 296 tax. So this is where, not to be confused with the Division 293, so it's not the best name, but this is where if you've got as an individual more than $3 million in super, and that's not in one particular fund, that's across all your funds. If you've got more than $3 million, you will pay an additional 15% tax on the earnings. And I say earnings loosely at the moment because that's where the complications arise. It can be paid personally. So that is what I think where the government's hanging their hat on it a little bit, going, it's not necessarily just taxing your super. If you've got cash flow issues, etc., you can elect to pay this personally. Yeah, thanks a lot. I'm not sure that's necessarily the greatest thing. But what's this mean? The earnings, I think, is where this is where the headlines are coming at the moment, because effectively they're going to be calculated purely on the change from your balance at the 1st of July to what it is at the 30th of June, adjusted for anything you've put in and taken out. So for the first time in Australian history, you're going to get taxed on unrealised gains. So if you've got assets that are just increasing in value, that you have not sold, that you've not generated any taxable income on, you will be taxed on.
So even if in a property that's sitting in there,
Yep.
and the super fund, if that is valued and goes beyond that.
Yep. The question's even in property, and yes, the short answer there is yes again. So I'll just work through the example here just to give you an idea of what it actually looks like. And I've done a very simple one here, but Andrew's got a total superannuation balance at 30th of June 2025 when this comes in of $3 million. So that's the cap. That's what they're saying. Anything above that, you're going to come after this. During the year, balance increases to $4 million. So at the 30th of June 2026, gone up $1 million. Property's been revalued. It's now worth $4 million, not $3 million. So his earnings in that year are, and I've got $4 million plus minus because there hasn't been contributions or withdrawals, is $1 million. Now that's not the ticket, the big ticket that's going to get taxed. It's not the $1 million. I think a lot of people are probably in the media, it's confusing, but I think people think if I've got gone from 3 to 4, am I paying 15% tax on that million? No. It's only on the proportion of the earnings that's above the 3 million. So this is where it does get a little bit better. So you are allowed to have $3 million and earnings associated with that without paying this. So that 1 million is 25%, hence the tax liability is then 15 by a million by 25%. In this situation, the tax bill is $37,500. So for round numbers, I've gone from 3 million to 4. I will pay $37,500.
How do you pay that?
That's where it comes back. So the question is how you pay it, and this is where the government goes, you can pay it out of the super fund or you can pay it personally. Because people are going, well, if I've got a property and it's gone from 3 to 4 million, or I've got any sort of illiquid asset, I might not have 37,500. So they then come and go, and this is going into the issues I see, they're going, well, you can pay that personally. Well, it doesn't mean I've got it personally either. So if I'm a 45-year-old that's invested really well, but in a very illiquid asset, I don't have like 50 grand to just throw at this, and they're going bad luck. Like, so these are the issues I see. Like, firstly, fundamentally, we've never taxed unrealised gains before. Like that's like a...
It's like a tax on a tax on a tax.
Yeah, and it's also a tax that may never be realised. So my property, my assets go from $3 to $4 million. I pay tax on that, and then it comes back to 3.6 and I sell it. I've paid tax based on it being worth 4 million last year.
They're not going to refund it.
They're not going to refund it. Like, you know who I don't want to be next when this comes in is a valuer, because there's going to be a lot of scrutiny being put on it. Like, if you're telling people they're paying tax based on the valuation that you're putting on things, so all those CFMG investments will have to be fairly...
Employee stock options in US companies have the same thing applied.
Yeah, you're right. There is situations around, like...
Farmers are going to be smashed the most.
But, and I think that going back to what Andrew says around the decrease, if in year 3, back to this situation, the balance, you paid your 37,500 and then your funds come back down to 3.5, you don't get it refunded. What you do is you carry forward a credit so that the following year, if it goes back up 500,000, you won't pay tax. And if it keeps going up, you will then, but you just carry forward a loss. All right. Cash flow is the big issue here, and liquidity, I think that's very unfair. The other thing that we've probably seen a little bit around is the indexation. This has been very, I think clearly said it's $3 million, that's it. They have not indicated that they'll index it at all. So with the way inflation is, etc., the $3 million, I think the 80,000 people that they initially said that this would impact is already the calculation saying it's more like 120, 130,000 by the time it comes in, and then it'll just be more. So indexation is the other issue there. What can be done? Probably haven't got time to run through this, but I'm hoping sanity prevails. You can take it out. You can take your money out if you are able to. If you're 45, you can't. You're just stuck with this. But there will be strategies around what you can do with it. I won't advocate taking the money. I've talked to a lot of people going, I'm just pulling money out. It may still not be your best option. So you need to look at it. And the investment mix. And I'll mention that one quickly because growth assets are very unattractive in this if you've got more than $3 million, because you've got the value going up that you have to pay tax on, but you don't have the income. So what I think we'll look to see is people's superannuation and whole investment philosophies will slightly change and go, okay, I'll go for more of an income-based approach in my super with maybe my more growthier assets in a trust or something outside. So I think over the next couple of years, once we know that if this is coming in, and it's looking like it is, what I'll be doing with my clients is sitting down, looking at their overall strategies and going, does it make sense to take it out? If so, what structure should it go in? And then what should we be investing in each side? So I think I've probably got to wrap it up there. Like our guests will be leaving us online, but I'm here obviously, so anybody in the room that wants to be asking questions of me or dealing into a bit of this, like, thanks for the chat, guys. I really appreciate that. And this is how I hoped it would work, go off on different tangents and sort of just talk rather than just me sort of lecture. But look, any questions, my details will be around too. So if you don't get a chance today, then please shoot me an email, give me a call. Happy to answer anything you've got.
Thanks, Clive. Who knew accounting could be so interesting? Yeah, some good stuff there. As I said, I've got a 67-year-old dad and a 66-year-old mum, so that's where my question came from. And the 67-year-old works and the 66-year-old doesn't. But I also like the 6 members because I've got 4 kids. So, no, thank you for everyone for joining us at home. For those of you in the room, dinner will be served. I think we go out there, turn left, and then turn left again and walk sort of 30 odd metres, and we'll sit down for dinner. But big thanks to Clive. You know, we amazingly could have gone for another half hour to an hour pretty easily, because it is a very interesting topic. And you know, you have to be prompted to think about these things no matter how old you are. It's very easy to be apathetic about your super. When you find out about these strategies, the light bulb's going off in your head, and hopefully you've taken the notes and you go home and actually utilise them, because sometimes you sit here and you get all these good strategies and advice, or not advice, and then go home, and by the time you got home you forget about it. So definitely make sure that you keep that top of mind, some of this stuff, because it is pretty interesting. And remember how your vote goes about that unrealised capital gains. Thank you.